4 massive crashes, 4 different eras, 4 sets of warning lights that all blinked years before the market fell. Imagine a grainy reel of panicked traders in 1929, the dot-com floor tumbling in 2000, Lehman collapsing in 2008, and the frantic sell-off of 2020. The same red warning overlay now pulses on a modern chart, 3 indicators flashing in unison. What if those lights are blinking right now? I'm not here to predict the future. I'm here to connect the patterns that history has left behind. In 2026, every one of those ancient signals is flashing together again. Debt is soaring, valuations are stretched beyond reason, cheap money is flooding every corner of the economy, and geopolitical tension is rising faster than any of us expected. The question is simple: are we standing on the brink of the next historic plunge? We'll walk through each major crash of the past 100 years, pull apart the exact signals that appeared before each disaster, and then line those signals up side by side with today's data. By the end, you'll see whether the calm before the storm is just a calm at all, or the first tremor of something far larger. If this is blowing your mind, hit subscribe and let's keep digging deeper together. Let's dive into the first case study, the crash that reshaped an entire generation. In the late 1920s, investors were buying stocks on margin faster than the economy could support. By the summer of 1928, the total borrowed amount used to purchase equities had ballooned to a level that dwarfed the actual cash flow of the market. At the same time, farmers across the heartland were producing more grain than anyone could consume, driving commodity prices into the abyss and forcing banks that had loaned heavily to agrarians into a precarious position. Add to that a wave of protectionist tariffs that choked international trade, and you have a perfect storm of debt, overproduction, and geopolitical tension. Those 3 pillars would reappear in every major collapse that followed. Fast forward to the turn of the millennium, when the internet promised to rewrite the rules of business. Companies with barely a handful of employees were going public at valuations that made the old Wall Street barometers blush. The price-to-earnings ratio for the technology sector surged beyond 100, while earnings remained a whisper. Central banks had lowered interest rates to historic lows, flooding the market with cheap capital that chased the hottest IPOs. The media turned the frenzy into a cultural phenomenon, glorifying anyone who could claim a .com domain as a ticket to instant wealth. Again, we see debt-fueled speculation, runaway valuations, and a flood of cheap money converging with a media-driven euphoria. The next major upheaval arrived in the late 2007 period, when the housing market had become a massive lever for financial institutions. Mortgage-backed securities were packaged and sold with ratings that suggested safety, even as the underlying loans grew riskier by the day. Leverage in the banking sector rose to levels that would have been unthinkable a generation earlier, and a sudden shift in borrower confidence triggered a cascade of defaults. The collapse of a single investment bank in the early autumn of 2008 sent shockwaves through the global financial system, exposing how deeply intertwined debt, overvaluation, and fragile confidence had become. Geopolitical uncertainty added another layer of strain as emerging markets reeled from the shock. Just 2 years later, a pandemic swept across the globe, halting economic activity in an instant. Governments responded with unprecedented fiscal stimulus, and central banks slashed rates to near zero, injecting liquidity into every corner of the economy. Asset prices from equities to real estate surged despite the underlying slowdown, creating a disconnect between market valuations and real-world productivity. Supply chain disruptions and geopolitical tensions over trade routes further amplified the sense that the system was being stretched beyond its natural limits. Once more, the hallmarks of high debt, inflated valuations, cheap money, and geopolitical strain lined up in a way that no analyst could ignore. Now, looking at the present moment, 2026, we see all those warning lights flickering together. Household debt has climbed to a point where monthly payments consume a sizable share of disposable income, while corporate leverage has reached heights not seen since the early 30s. Valuation metrics for both equities and real estate are perched at levels that echo the peaks of the dot-com era and the housing boom. Central banks, after years of ultra-low rates, are beginning to nudge policy upward, but the lag in the broader economy means that cheap money continues to flow into risk-laden assets. Meanwhile, geopolitical flashpoints are emerging across several continents, threatening to disrupt trade and energy supplies at a scale reminiscent of the post-World War era. When you stack these 4 variables side by side, the pattern looks unmistakably familiar. So, what does this mean for you, the viewer, sitting at the edge of your screen? It doesn't spell out a precise date or guarantee a crash, but it does suggest that the market is walking a tightrope with fewer safety nets than before. Historically, when these four forces converge, the result has been a sharp correction that reshapes the financial landscape for years to come. The choice now is whether to recognize the signs early and adjust your strategy, or to wait until the storm hits and scramble for cover. I want to hear from you. Do you see the same parallels in the data you track? Have you already taken steps to protect your portfolio, or are you still on the sidelines? Drop your thoughts in the comments below, and let's start a conversation that could help us all navigate the uncertainty ahead. If this deep dive sparked new ideas or raised questions you didn't expect, give the video a thumbs up and share it with anyone who might benefit from a clearer view of the market's currents. And if you haven't already, hit that subscribe button and ring the notification bell so you won't miss the next episode where we break down the tools you can use to hedge against potential downturns and position yourself for whatever comes next. Stay curious, stay vigilant, and remember, the best defense against a surprise crash is an informed mind.